The Barbell Strategy, How to Invest Like a Genius, Maximum Protection Plus, Explosive Profit. I watched my entire portfolio collapse in 48 hours. Everything I thought I knew about investing, every principle I'd learned from the experts, every diversified mutual fund I'd carefully selected, it all evaporated like smoke. The year was 2008, and I was sitting in my apartment watching the numbers on my screen turn red, one after another, feeling my stomach twist into knots. But here's the thing that still haunts me. What really keeps me up at night even now, years later. It wasn't just that I lost money. Everyone lost money in 2008. What destroyed me was realizing I had been playing a game I didn't understand, following rules that were designed to make me feel safe while actually exposing me to complete ruin. And then, in the wreckage of that financial apocalypse, I discovered something that changed everything. A strategy so counterintuitive, so brutally honest about the nature of risk, that most people reject it the moment they hear it. But the few who embrace it, the ones who truly understand what Nassim Taleb was trying to tell us, they sleep peacefully while markets crash around them, and they capture gains that seem almost obscene when black swan events strike. This isn't about beating the market. This is about surviving what's coming, and I need you to understand something right now. What's coming is always worse than you think. Let me take you back to that moment when everything clicked. I was reading Nassim Taleb's book in a coffee shop 3 months after the crash, still licking my wounds, still trying to understand how I could have been so wrong. And he described this investment approach called the Barbell Strategy: 90% of your money in extremely safe assets, 10% in extremely risky, potentially explosive opportunities. My first reaction was exactly what yours probably is right now. That's insane. That's the opposite of what every financial advisor tells you. Where's the middle ground? Where's the balanced portfolio of moderately risky stocks and bonds that's supposed to carry you safely into retirement? And that's when Taleb hit me with the truth that nobody wants to hear. The middle ground is where you die. Those moderately risky investments, the ones that feel safe because they're not extreme in either direction, they're the ones that will destroy you when the system breaks. Because here's what nobody tells you about risk: it's not linear. It doesn't spread itself evenly across your portfolio like butter on toast. Risk hides, it accumulates in places you can't see, and then it detonates all at once. If you're wondering whether I'm going to ask you to like and subscribe, yeah, I am, but not because I need the algorithm boost. I need you to save this video because what I'm about to show you contradicts everything you've been taught, and you're going to want to come back to this when the next crisis hits. The traditional approach to investing is built on a beautiful lie. Diversification, they tell you, is your shield against disaster. Spread your money across different stocks, different sectors, different asset classes, and you'll be protected. It sounds so reasonable, so scientific. Modern portfolio theory won the Nobel Prize for crying out loud. But here's what Harry Markowitz and his disciples didn't account for. Correlation breaks down precisely when you need it most. In normal times, yes, your tech stocks might zig while your utility stocks zag. Your bonds might cushion the blow when equities stumble. Everything balances out in a comforting dance of mathematical precision. But when the real crisis comes, when the black swan lands, everything correlates to one. Your diversified portfolio becomes a single bet that the system holds together. And if the system breaks, if we hit another 2008, or another COVID crash, or whatever nightmare is brewing that we can't even imagine yet, your carefully balanced portfolio drops like a stone, all of it, at the same time. The barbell strategy starts from a completely different premise. It assumes fragility. It assumes that catastrophe is not only possible, but inevitable. It assumes that your predictions about the future are probably wrong, that expert forecasts are noise, that the bell curve that underlies all traditional finance is a dangerous fantasy. Nassim Taleb isn't just some armchair philosopher throwing stones at Wall Street. He made his fortune, real wealth that meant he never had to work again, by applying this exact strategy. He kept most of his money in treasury bills, the most boring, safe investment imaginable. And he put a small percentage into out-of-the-money options, bets that would pay off massively if markets crashed. When the 1987 Black Monday crash hit, When the Dow Jones dropped 22% in a single day and supposedly sophisticated investors were jumping out of windows, Taleb made a fortune. Not because he predicted the crash. He couldn't have told you it would happen on October 19th any more than you could. He made money because his strategy was designed to benefit from unpredictability itself. Think about the elegance of this for a second. While everyone else was trying to forecast the unforecastable, trying to predict which way the market would move and by how much, Taleb simply said, "I don't know, and I'm going to invest accordingly." The 90% in safe assets meant he could sleep at night. It meant he could survive years of nothing happening, years of his risky bets expiring worthless, years of watching other investors make steady gains in the middle of the risk spectrum, while he seemed to be sitting on the sidelines. But that 10%, those asymmetric bets, they were his lottery tickets for catastrophe. You're probably thinking this sounds great in theory, but how does it actually work in practice? Let me break down the mechanics, because the beauty of the barbell strategy isn't just in its philosophy, it's in its brutal simplicity. The 90% safe side isn't sitting in a savings account earning nothing. You're putting it in treasury bonds, in tips that protect against inflation, in money market funds, in assets that have virtually zero risk of principal loss. Yes, the returns are modest. Yes, you're not going to get rich off this portion of your portfolio. But here's what you are getting. You're getting certainty. You're getting the ability to live your life without checking your portfolio every 5 minutes. You're getting insulation from volatility. And most importantly, you're getting ammunition, because when markets crash, when everyone else is forced to sell their positions at a loss because they can't handle the pain, or they need the money, or their margin calls are coming due, you have dry powder. You have cash that hasn't evaporated. You can be greedy when others are fearful, as Warren Buffett likes to say, but only if you actually have money left to be greedy with. The 10% risky side is where things get interesting, and this is where most people completely misunderstand Taleb's approach. This isn't about buying speculative tech stocks or gambling on cryptocurrency or day trading options. The risky 10% is about asymmetry, about finding opportunities where your downside is capped, but your upside is unlimited, or at least enormous. Taleb used option strategies, specifically buying far out-of-the-money puts that would explode in value during market crashes. But the principle extends far beyond options. You could put this money into early-stage startups, knowing that 9 out of 10 will fail, but the 10th might return 100 times your investment. You could invest in frontier technologies, in biotech companies developing breakthrough drugs, in any opportunity where you can lose only what you put in but potentially gain multiples of that amount. The key is that you have to be genuinely comfortable losing the entire 10%. Not theoretically comfortable, not comfortable in the abstract, but actually okay with that money going to zero. Because much of the time, that's exactly what will happen. Your options will expire worthless. Your startups will fold. Your speculative bets will fail. And that has to be fine because you've only risked 10% and your 90% is safe, compounding slowly and steadily, keeping you afloat. This is the psychological discipline that separates successful barbell investors from everyone else. Most people can't handle watching their risky bets fail repeatedly. They lose faith. They abandon the strategy right before it would have paid off. There's a deeper truth here about the nature of risk that our educational system and financial industry desperately want to hide from you. We've been taught to think of risk as something measurable, something that can be quantified with Greek letters and probability distributions. We calculate betas and standard deviations and value-at-risk metrics, and we convince ourselves that we've tamed uncertainty. But Taleb's entire body of work, from Fooled by Randomness to The Black Swan to Anti-Fragile, is a sustained argument against this illusion. The risks that matter, the risks that will actually destroy you, are the ones that fall outside your models. They're the events that your probability distributions assign such a tiny chance to that you effectively ignore them. And then they happen. And they happen more often than they should according to your models, because reality doesn't follow a bell curve. Reality has fat tails, extreme events that occur far more frequently than normal distributions would predict. The 2008 financial crisis was supposed to be a 25 standard deviation event, something that should happen once in the entire history of the universe. Except it happened. The COVID crash, the long-term capital management collapse, the 1987 crash. These black swans keep landing, and every time they do, the experts act surprised and revise their models and promise it won't happen again. The traditional portfolio, the 60-40 stocks to bonds allocation, or whatever variation your advisor sold you, is optimized for a world that doesn't exist. It's optimized for normal times, for the steady grinding upward of markets punctuated by predictable corrections. And in that imaginary world, it performs reasonably well. You get your 7% annual returns, you rebalance quarterly, you feel like a responsible adult. But we don't live in that world. We live in a world where decades of calm can be followed by weeks when decades happen, to paraphrase Lenin. We live in a world where the derivatives market is measured in quadrillions of dollars, where high-frequency trading algorithms can crash markets in microseconds, where central banks have inflated asset bubbles to sizes that would have been incomprehensible to previous generations. We live in a world that is fundamentally fragile, and getting more fragile every day. The Barbell Strategy is designed for this world, the real world, not the fantasy world of efficient markets and rational actors. It says, I don't know when the crisis will come. I don't know what will trigger it. I don't even know if I'll be alive when it happens. But I'm going to structure my investments so that I survive and potentially thrive when fragility reveals itself. And make no mistake, it will reveal itself. It always does. Let me tell you about something that happened to me in 2020 that crystallized why this strategy works. I had implemented my own version of the barbell approach about 5 years earlier after finally digesting Taleb's lessons. 90% in a mix of treasury bonds and tips, 10% split between some tech startup investments, and a small position in tail risk hedging strategies. Nothing sophisticated, nothing that required constant monitoring. And then March 2020 hit, and COVID sent markets into freefall. The S&P 500 dropped 34% in just over a month. I watched friends, smart people with good jobs and diversified portfolios, panic selling their positions, locking in massive losses, unable to stomach the volatility. Their financial advisors were calling them, trying to calm them down, feeding them lines about staying the course and time in the market beats timing the market. All true in normal times, all useless when you're watching your retirement fund cut in half. But I was calm, eerily calm. The 90% of my portfolio in safe assets had barely moved. I'd lost a tiny bit to inflation risk, but nothing that mattered. And the 10%, well, part of it had gotten destroyed. My startup investments were facing existential threats, some of them wouldn't survive. But my tail risk positions, those insurance policies against disaster, they had exploded in value. When the dust settled in late March, when markets found a bottom and the Federal Reserve announced unlimited quantitative easing, I had actually made money. Not because I was smarter than anyone else, not because I had predicted COVID or the market crash, but because my strategy was designed to benefit from volatility itself. I had optionality. I could choose to sell my tail risk hedges and lock in gains, or hold them in case things got worse. I could choose to move some of my safe assets into beaten-down stocks, buying quality companies at fire sale prices while everyone else was selling. Or I could do nothing, just sit there with my wealth intact, waiting to see how things developed. That's what the barbell gives you, options. Literal options in the financial sense if you're trading them, but more importantly, options in life. The freedom to make choices when others are trapped. And isn't that what wealth is really about? Not the number in your account, but the range of choices available to you? The traditional balanced portfolio gives you the illusion of choice, right up until the moment when you actually need it. And then you discover you're just as trapped as everyone else. Your retirement account is down 40%. You're 3 years from retirement. What choice do you have? You hold on and pray it recovers in time. That's not choice, that's hope. And hope is not a strategy. There's a question I know you're asking, because everyone asks it when they first encounter this idea. If the barbell strategy is so good, if it's so obviously superior to traditional diversification, why doesn't everyone do it? Why do financial advisors still push balanced portfolios? Why do pension funds and endowments still invest across the risk spectrum instead of concentrating on the extremes? The answer reveals something uncomfortable about the financial industry. Traditional diversification is easier to sell, it feels more reasonable. It allows advisors to show you charts and graphs demonstrating steady returns with manageable volatility. It generates fees through active management and rebalancing. It keeps you engaged, checking your portfolio, feeling like something is happening. The barbell strategy, by contrast, is boring 90% of the time. Your safe assets just sit there, earning minimal returns. Your risky bets mostly fail. Years can go by where you would have been better off in a standard portfolio, and that's intolerable to the financial industry, because they need you to believe that activity equals progress, that trading and rebalancing and tactical allocation adjustments are adding value. They need you to believe that they can predict the future, or at least navigate it skillfully. Because if you accepted that the future is fundamentally unpredictable, why would you pay them 2% of your assets every year? But there's a deeper psychological reason why most people reject the barbell strategy, and it has to do with how we experience regret. Imagine two scenarios. In scenario 1, you follow the barbell approach. Markets go up steadily for 5 years, your friends are making 12% annually in their balanced portfolios. You're making 4% on your safe assets while your risky bets flame out. You feel like an idiot. You feel like you're missing out. Every dinner party conversation about investment returns is a reminder of your underperformance. That's painful. Now, scenario 2, you follow traditional advice. You diversify across the middle of the risk spectrum. Everything seems fine for years. And then the crisis hits and you lose half your wealth in 3 months. That's also painful. But here's the key difference. You have company. Everyone lost money. Your advisor lost money. The pension funds lost money. Your suffering is legitimate, socially validated. You're a victim of unprecedented circumstances, not someone who made an unusual choice that didn't pan out. We're far more willing to accept conventional failure than unconventional underperformance, even when unconventional underperformance protects us from catastrophic loss. It's the same reason people get fired for buying IBM, as the old saying goes. Nobody gets fired for following the consensus, even when the consensus drives off a cliff. Let's talk about the practical implementation, because theory is beautiful, but application is where most people stumble. The first question is, what qualifies as safe for the 90% portion? Taleb would say treasury bonds, and he has a point. They're backed by the full faith and credit of the US government, which, whatever your political views, remains the closest thing we have to a risk-free asset. But you need to think about what you're protecting against. If you're worried about inflation destroying your purchasing power, maybe you want tips instead. If you're worried about dollar devaluation, maybe you want some allocation to foreign government bonds or even gold. The principle is that this 90% should be in assets that won't disappear, that won't correlate to one with everything else in a crisis, that will preserve your capital in real terms. Notice I said preserve, not grow. This isn't the part of your portfolio that makes you rich. This is the part that keeps you alive. The 10% is where you hunt for asymmetry, and this requires a completely different mindset. You're not looking for good investments in the traditional sense. You're looking for lottery tickets with positive expected value, for opportunities where the odds are against you, but the payout is so large that it compensates for the low probability. Venture capital has this property. Most startups fail, but the winners can return 1,000 times your investment. Cryptocurrency, whatever your opinion of it, has this property. Bitcoin was worth pennies a decade ago. You could have lost your entire investment 100 times over, but if you'd put $1,000 in and forgot about it, you'd be a millionaire. I'm not recommending Bitcoin specifically, I'm illustrating the principle. Deep out of the money options have this property. Investing in your own business or skills development has this property. The key is that you're deliberately seeking positive skew. Situations where your losses are bounded, but your gains are not. And you're accepting, even embracing, the fact that you'll be wrong most of the time. This is emotionally difficult for people raised on participation trophies and growth mindsets. We want to be right. We want to see progress. We want to feel like our efforts are paying off. But in the 10% bucket, failure is the default. You're paying premiums for insurance that usually doesn't pay out, buying lottery tickets that usually lose, planting seeds that usually don't grow. The discipline is to keep doing it anyway, to keep allocating that 10% even when the previous 10 allocations went to zero. Because you only need to be right once for the strategy to work. Once in a decade, once in a lifetime maybe, but that one time can transform everything. There's a mathematical beauty to the barbell that becomes clear when you run the numbers over long time horizons. Let's say your 90% safe allocation returns 3% annually, boring but steady. And let's say your 10% risky allocation loses money 9 years out of 10. But in that 10th year, it returns 10 times your investment. Over a decade, your 90% has grown to about 121% of its starting value. Your 10% has been wiped out 9 times, so you've lost 90% of that initial 10%. But in the 10th year, it goes 10x. So you start with 90 in safe and 10 in risky. After 10 years, you have about 109 from the safe side and about 100 from the risky side, assuming you replenish it each year. Total return over the decade of roughly 110%, or about 7.7% annually. That's competitive with stock market historical averages, but here's the crucial difference. You achieved it with far less volatility, far less stress, and far less exposure to catastrophic loss. And that's using conservative assumptions. If your risky bets do better than 10x once per decade, if you hit a genuine black swan event that pays 50x or 100x, your returns can be extraordinary. But even in the base case, even if you never hit a home run, you're matching market returns with a fraction of the risk. That's not a free lunch. Those don't exist. That's a different kind of lunch, one that costs you the pain of watching your risky bets fail repeatedly, and the opportunity cost of missing steady, middle ground returns. The barbell strategy forces you to confront an uncomfortable truth about yourself and about investing in general. You cannot have it all. You cannot have safety and massive growth and steady, predictable returns all in the same portfolio. The traditional approach promises you can. It says, diversification gives you the best of all worlds, but it's lying. What diversification actually gives you is mediocrity in normal times and catastrophic loss in extreme times. The barbell makes you choose. It makes you separate your assets into 2 distinct buckets with 2 distinct purposes, and it makes you accept that each bucket will underperform at different times. When markets are climbing steadily, your safe assets will underperform and your risky bets will mostly fail. You'll look stupid. When markets crash, your risky bets will fail even faster, but your safe assets will protect you and potentially some tail risk hedges will pay off. Over a complete cycle, over boom and bust, you come out ahead, but you have to have the stomach to endure looking wrong for extended periods. This is where most people fail, not in understanding the strategy intellectually, but in maintaining it emotionally. The barbell demands discipline of a kind that feels almost inhuman. It demands that you stick with an approach that feels wrong, that your friends are mocking, that financial media is ignoring, because you understand something they don't about the nature of risk. I want to address the most common criticism of the barbell strategy, because you're going to hear it if you start implementing this approach. People will tell you that you're being too conservative, that you're leaving money on the table, that you'll never build real wealth by keeping 90% in safe assets. And they'll have charts and data to back up their claims. They'll show you how a standard 60-40 portfolio has returned 8 or 9% annually over the past 50 years, how you're giving up half your returns for some theoretical protection against events that rarely happen. Here's what they're missing, and here's what you need to understand in your bones. Past performance, especially past performance over the relatively calm second half of the 20th century and early 21st century, tells you nothing about future risk. We've lived through the most extraordinary period in human history, a period of unprecedented peace, unprecedented technological progress, unprecedented central bank intervention in markets. The sharp ratios and efficient frontiers and beta-adjusted returns that look so good in hindsight were earned during a time when the United States was the undisputed global superpower, when nuclear weapons prevented major wars, when the Bretton Woods system and then the petrodollar created massive demand for U.S. assets, when demographics favored growth, when easy oil and resources supported expansion. That era is ending. Maybe it's already ended. We're entering a period of deglobalization, aging populations, resource constraints, political polarization, technological disruption that threatens entire industries, artificial intelligence that could transform everything we know about work and value, climate change that will reshape where and how people live, and debt levels that are mathematically unsustainable. I'm not making predictions about which of these threats will materialize or when. I'm saying the future is fundamentally more uncertain, more fragile than the past we're using to calibrate our risk models. And in that environment, the barbell isn't conservative, it's realistic. It's the only approach that acknowledges what we don't know and can't predict. Every other strategy, every balanced portfolio and efficient frontier and risk-adjusted return calculation is implicitly betting that the future will resemble the past, that the patterns that held for the last 50 years will continue for the next 50. The barbell is betting that they won't, or more precisely, it's refusing to bet either way. It's saying I don't know what's coming, so I'm going to be prepared for anything. And if nothing catastrophic happens, if markets continue their steady climb and my risky bets keep failing, well, I'll have underperformed, but I'll be fine. But if something does happen, if we get our 1929 or our 2008 or our something we can't even imagine yet, I'll be more than fine. I'll be positioned to benefit. Let me bring this back to something personal, because ultimately, financial strategy isn't about numbers on a screen. It's about the life you want to live and the person you want to be. When I implemented the barbell strategy, when I moved 90% of my investable assets into boring government bonds and tips, my friends thought I'd lost my mind. This was 2015. The market had been climbing for 6 years since the financial crisis. Everyone was making money in tech stocks and real estate. I was the weird guy sitting on the sidelines earning 2% while they were pulling down 15–20% returns. And I won't lie, it hurt. It hurt to feel stupid, to feel left out, to wonder if I'd made a terrible mistake. But something else happened that I didn't expect. I stopped caring about markets. I stopped checking my portfolio every day. I stopped feeling that spike of anxiety every time I saw a headline about volatility or corrections or recession fears. That 90% in safe assets gave me something more valuable than returns. It gave me peace. And the 10% in risky bets, knowing that it might go to zero but might also change my life. That gave me something too. It gave me skin in the game, a stake in the future, hope that I might catch lightning in a bottle without risking everything I'd worked for. That combination, safety plus optionality, turned out to be exactly what I needed psychologically. So here we are at the end, and I need to tell you something that might disappoint you. I can't guarantee the barbell strategy will make you rich. I can't even guarantee it will outperform a traditional portfolio over your investing lifetime. Because I don't know what the future holds, and neither does anyone else. What I can tell you is that it will change your relationship with risk and uncertainty. It will teach you to distinguish between what you can control and what you can't. It will protect you from catastrophic loss while preserving your ability to benefit from extreme events. It will let you sleep at night. And maybe most importantly, it will align your investments with reality rather than with the comforting fantasies that the financial industry sells. We live in a world of black swans, of fat tails, of events that shouldn't happen but do. The barbell strategy is the only approach I've found that takes this seriously, that doesn't pretend we can predict the unpredictable or diversify away the truly catastrophic risks. If this resonates with you, if you're tired of conventional wisdom that leaves you exposed to ruin, I need you to do something for me. Smash that like button. Not just because it helps the algorithm, but because it tells me there are others out there who get it, who understand that the emperor has no clothes. Subscribe to this channel, because I'm going to keep exploring ideas that contradict mainstream thinking. Ideas that might save you when everyone else is drowning. And most importantly, comment below. Even if you disagree. Especially if you disagree. Tell me why I'm wrong. Tell me what I'm missing. Tell me about your own experiences with risk and investing. This conversation is too important to keep to yourself. The next crisis is coming. I don't know when. I don't know what will trigger it, but it's coming. The question is whether you'll be ready.